My name is Andrew Rechtschaffen. I'm the CEO and portfolio manager of Arex Capital. This morning I want to tell you a bit about our investment approach and philosophy and about our firm. So to start, let me give my background in brief. I started my career at Morgan Stanley Investment Banking back in 2000, which feels farther in the rearview mirror every day. I was there for a couple of years, which worked at Greenlight Capital, hedge fund here in New York. I was there for about 3 years. I was a partner there. I left to go to Citadel in Chicago. I was a managing director in Citadel's principal strategies group. I managed a portfolio, value-focused investing with a catalyst overlay at Citadel for a couple of years. Came back to New York to launch a firm. I launched the firm in Jan 1 of 2008. We had, I'd say, a successful ramp-up period and a challenging first year, but managed the firm for 3 years. Closed the firm at the end of 2010. Came back to New York to rejoin. I'm sorry, back to New York. Came back to Greenlight Capital in March of 2011. Was there for another 6 years until early 2017 when I left to start Arex Capital. We launched Arex officially on October 1st of 2017. I've been around now 4.5 years. We are a long-only, value-oriented, equities-focused manager. We focus on larger, small-cap and mid-cap situations. Our market cap range, we say, is 1 to 25 billion, but really 1 to 10 billion is the sweet spot of our investment program. We focus on North America and Western Europe. There are no emerging markets in our portfolio. Focus on mature, established markets. Our firm consists of 7 individuals. There's myself, 3 other members of the investment team, and 3 members of the operations team. We take a minute to discuss why we launched the firm and our view of value investing and how it's evolved. So we launched the firm. We thought there was a market need and an opportunity to create a new version of value investing for investors to consider. We think value investing has changed materially, certainly during my 20 years in the industry. When I started back in 2002 and certainly before that, value investing often consisted of finding low multiple securities, low multiple investments, cheap on earnings, on cash flow, being patient, buying, being patient, and ultimately being rewarded for your patience. The market ultimately reassessed the company, and if you stuck around, you eventually achieved a better valuation and a better exit point on your investment. And that's because in those years, the reasons why these stocks were cheap were frequently because of temporary issues. They missed a quarter, there was a temporary negative trend in their business that would eventually dissipate because of the passage of time. And the patience was enough to actually reward you for your investment. What has changed in our estimation, why a new approach to value investing is needed, is that today, unlike in those days, the cheapest companies, the bottom decile, bottom quartile of valuations, are actually companies who either have a structural challenge in their business, a structural risk to their business, or the market at a minimum feels there is a medium-term uncertainty around their profit pool, around the sustainability of their business, and thus puts a low multiple on current period earnings. The problem is those situations, when you have a low multiple of earnings, low multiple of cash flow, because of a structural issue or of a secular uncertainty, are hard to resolve. The market doesn't just change its mind one day and say, actually, you know what, we were wrong, we're reconsidering. And so these can stay cheap for a very long time. These are the value traps you hear many value managers complaining about and banging the tables about. And you see these long-term sideways charts that simply are poor investments. Right? Part of this whole value lagging growth we've heard about for so long is this idea where these companies that appear cheap, the market doesn't lose its uncertainty and therefore does not reward the company with a higher valuation. Even if earnings are growing, the multiple can compress a little bit and you end up with the same stock price. And this has become a theme, we think, that has plagued the value investing strategy for many, many years now. So we believe a different approach, a new approach, was and is necessary to the value investing strategy. So let me explain what we do and what our approach is and how we think we offer a solution, not maybe the solution, but a solution to the value investing conundrum. We think our approach is the best of bottom-up value investing at its core, being value investors, but with aspects that are responsive to the change that has taken place in the marketplace. So first and foremost, and what defines our investment program and our strategy, is we are a high concentration manager. So I believe that concentration is at the core, that should be at the core of any good equities-focused investment program that is fundamental in nature. And by the way, I say concentration for us, I mean 15 to 20 stocks. And typically half of our capital is in our top 5 ideas. Our belief is that every investor that we have is diversified at the investor level. And we should be diversifying away from our best ideas at the fund level by simply adding new names, more exposures, and having less exposure in our best and most differentiated thoughts. We believe this will lead to the highest returns for our investors over time. And at the investment level, the highest quality outcome would be if every manager had only their best ideas in a sense, in their portfolio. So we believe in concentration and having all of our capital in only our best and most differentiated ideas. Two other benefits that come along with that. One is that by having the strategy that combines both concentration and, as I'll explain shortly, a longer time horizon, we have less turnover and less names to find, fewer names to find in the portfolio. We have fewer names to find, therefore we can be more disciplined in how we approach the market, how we consider new opportunities. We don't have to constantly replenish the portfolio the way a more diversified manager with higher turnover might have to do. And secondly, because we have a team that, again, myself plus 3 other members of the investment team, there's 4 of us covering, let's call it 15 to 20, call it 18 names. Each of my analysts covering 6 names can actually do more work and have, I think, more in-depth knowledge of each investment because there's fewer names to cover. And I can have the intimate knowledge I want to have of each investment opportunity, as opposed to a manager managing many dozens of securities and knowing them in the depth that you'd like to is simply impossible. The concentration at the core of our investment approach.
So Andrew, one of my questions that I'm going to jump in a couple of times here, but my question I have is that is there a so you're talking about value investing. Is the fact that the market valuation is so high in general, is that the opportunities are just bigger because the market's bigger, right? So you can't take this concentrated approach, or is it something, something different? Because I mean, obviously everything is so bubbly and overvalued that something that looks reasonable, in the context of today's market may have more run room.
Yes. It's interesting, value versus growth investing or value. So yeah, large growth and large cap growth has been a dominant winning strategy for the last 10 years. Any value investor, I think being intellectually honest, would acknowledge it's been a good run for the growth community. I think that the baton, as you alluded to in your comments, maybe in the process of being handed off right now. I think growth certainly has been stretched. Now we've seen a large retraction, a large retracement. Like just over the last few months. So you've seen, many sort of companies down 50, 60%, even large cap growth down 10, 20%, which was a big move for those companies. But I think more as you move into a less accommodative Fed policy environment, as rates move higher, as the kind of free money, as you alluded to, is not as available for companies to access, that may restrain the seemingly unbounded path of these growth companies and their valuations, and may cause people to actually reconsider, should I be owning companies that have real cash flow generation, trade at low multiples of earnings, and have a more fundamental sort of value-oriented basis? I think that's a reconsideration happening now. We would say, for our business, of course, we would say that this is the moment where value can begin to outperform growth. And it's not to say that I think if you own Microsoft, it's fine, you'll be fine, but there will be better opportunities for outperformance in companies that are more akin to the kind of companies that we invest in.
Perfect. Okay, great.
Yeah. And so again, at the core, we are fundamental investors. We have a bottom-up approach to our portfolio construction. We research every name is fundamentally researched and is value-oriented in nature. And I say value-oriented to really explain what that means and why we differentiate it slightly from pure deep value, right? So entry-level valuation is at the core of what we consider. We are buying companies that are traded at low multiples of earnings, of free cash flow, of EBITDA. We are not, as I mentioned, we're not growth investors in any way. We do find businesses that are growing, though they trade at sort of valuations, at low valuations, but we also never rely upon valuation alone. We never rely upon low multiples as a thesis in and of itself. There has to be more than that. Right? And we always make sure in any investment that we're going to make, we always consider what is the debate the market is having about this company? Why is it cheap? And if the answer is the market has a secular question, even if we have high conviction that we have the answer, that the market is wrong and that there's no basis for the secular concern, we don't invest because we understand how long it can take, how difficult it can be for the market to actually resolve that uncertainty. And we're not trying to deploy capital just to be quote unquote right about the facts. We actually want the investment to appreciate. So there's a practical overlay to the value investing that we do, which takes into consideration not only valuation and business quality, but also can we be successful with this investment in the markets. So a distinction that we call that value oriented as opposed to deep value, to the Graham and Dodd, just buy low multiples and hope that they will eventually be rewarded with higher valuation.
So there's a different time frame that's involved with, if you're secular risk, we're going to stay away from that. So we're looking for somewhere where all the lights are green, so to speak.
Yeah, and I'll come to the overlay that we have in our program, which speaks to that exact point. So every investment we make, again, is fundamentally researched. We refer to it as building the mosaic of information. And it's typically a 4 to 6 week process at a minimum in the work that we do. It's deep fundamental work. It's reviewing, as you might imagine, it's company filings, talking to the buy side, the sell side, engaging consultants to understand the company's ecosystem, all to build out the mosaic of information to allow us to construct a financial model. The work we do will teach us about what the company's top line prospects are, its margin prospects are, its free cash flow conversion prospects are, to allow us to build the financial forecasts that will support our valuation case and our view of fair value for the equity. And we do, it's important to note, we are fundamental in nature, but we also have a very market-based reality check on our work. So what I mean by that is when we value a security, we do things like DCF analyses. I mentioned before, I went to Wharton, so I studied this for most of my college life, and we certainly respect what DCFs can be. We also know what they cannot be, right? They cannot be the ultimate arbiter because they're so subjective in nature. You change the discount rate by a couple of percent, and suddenly you've created or destroyed value in a very abstract way, but that doesn't translate to public market equities. And so we consider how the public market investors, how they consider the situation. How will they consider this company once they understand it to be what we believe it to be? If we are correct in our thesis on this company and its prospects, what multiple, what valuation will the market apply to this business? And that has to support our return case for why a company is an interesting investment. So DCF is a sanity check, but it's market-based, reality-based valuations that ultimately define our interest in a company and our view of the fair value of the security. So once we've done the work, this many weeks of work that we do to understand the company and all aspects of it, there are two called threshold issues for us that we must have in every situation to make it investable. First is the return available in the situation. We must see at least a 50% return over a 2-year period. So every investment, we have a 2-year horizon when we start. It's at least up 50 over 2 years. Obviously, we're targeting more than 50. And that's informed both by our view that we want to achieve a 20% net return or better for our investors, and our view that that is an acceptable equity-like return to enjoy for the risk you're taking in owning an equity security. So up 50 is the minimum over 2 years. Obviously, we look for more than that. And if we don't see that level of return to a conservatively underwritten base case, we don't invest. And again, because we can be disciplined and have fewer days to find, we don't have to round down to 45 or 40, it's 50 or better, or we don't invest, or we're patient to wait for the opportunity to be at the right price for us. That's the first. The second criteria, though, which speaks to the point you were asking about earlier, about sort of the time horizon and all this, is even though we have a 2-year horizon when we start, we have a rule, which is if we don't have a view in the first 12 months of what will the catalyst be, what will the series of events be that will begin to cause the market to change its view of this company, we don't invest. We have to have a perspective on what will cause the market to start to care. You don't wake up in the morning and say this 8 times company should be 12 times. It doesn't just happen. Has to be some change in perspective for market participants to say, you know what, we view this company differently now for some reason, and we're going to revalue the equity accordingly. So we can love the valuation, we can love the facts, love the company, love everything about it. If we don't have a view on the catalyst path or the value unlocking events that are going to take place, we will not invest. And so when you put those two together, if we have both the level of return that we seek and a view on what will begin the unlocking process, then we have an investable situation. And I should emphasize, we start with a 12-month kind of catalyst perspective. It doesn't happen all at once. So the catalyst can happen or the events can begin to unfold. They'll begin to cause the value recognized by the market. We've owned things for multiple years. And again, we start with a 2-year horizon. One of our investments in our portfolio, ECN Capital, we bought on day 1 of the fund in 2017. We own it today, 4.5 years later. We love to own things that the facts get better as you own it and continue to compound capital for you. But at the beginning of the investment, we must have a view on that we're not going to be sitting in a multi-year sideways frustrating situation, and have a view on what will cause the market to begin to care. Should I be looking to the camera more?
Yes.
Oh, sorry.
Can you give an example of catalyst that you use?
Yes, I actually have 3 examples.
Oh, perfect.
So there are 3 investment types that we have in our portfolio. We have active engagement or activism. We have what we call new securities, and we have what we call discontinuous change. Each of the 3 have embedded catalysts in them that will play out over the lifetime of our investment that will allow us to realize value and realize a return on our capital during an acceptable time horizon.
I'm sorry, what was the third one? You had
So discontinuous change.
Discontinuous change.
Yeah. So first we talk about active engagement or activism. These are cases where we see a company that trades at a significant discount to its fair value, to its intrinsic value, where we don't necessarily have a view that the company in and of itself will be taking action to unlock or address the discounted valuation. We will engage the company actively, always privately at the outset, to ask them to consider taking steps to unlock the value through specific discrete steps. And we do a full assessment of the company's sort of activist vulnerability. We understand the company's corporate governance, history of management's performance, history of the share price to make sure that if we engage actively, they will have to take us seriously. We don't go after companies that are doing well because they can continue doing what they want to do. Companies that have not performed for shareholders, but where there's a lot of unrecognized value, those are the kinds of opportunities that we find compelling and interesting. So let me give examples of the types of situations generally, and I'll give one specific example that we were involved with recently. So the two activist types that we focus on, number one, are what we call public market orphans. This is where the company is healthy, a healthy growing business that for some reason the market fails to put a proper valuation on the company, about their business model, about something about the way that they engage the markets. We see oftentimes companies that are even multi-billion-dollar companies have no sell-side coverage, limited buy-side sponsorship, just trade at silly valuations. And we will do work to ascertain, is there either a private equity firm that could wish to own this company or a strategic acquirer who could extract synergy and create value by having this company be part of their larger public structure or their larger corporate structure. And if we determine that actually there's a buyer who would want to own these assets at an appropriately interesting premium, we will engage the company and say you should be reconsidering your public market existence and maybe either going private where the private buyer can earn returns on their capital via cash-on-cash returns, or be part of a larger company where the strategic acquirer can extract synergies and realize value in that fashion. That's the first type. Second type is what we call mini conglomerates. We actually like these a little better if I'm ranking the two. These are where you have companies that have multiple lines of business that are not synergistic, that don't go together naturally. And these companies frequently trade at large sum of the parts discounts or discounts to their fair asset value because public markets investors like simplicity. They don't like complexity. They like pure play focused enterprises. They don't necessarily like these diversified, messy situations and structures. And by unpacking the pieces, you can actually extract significant value. That letting each of the company's component parts trade at their appropriate valuation, you can actually have material returns on your capital. And particularly if there's no dyssynergy in separating the businesses, we've had nice success in this area. I can give one example if it's helpful.
Yeah, that'd be great, yes.
So we were involved with a company, we still are, called Spectrum Brands. Spectrum Brands is a consumer products focused company. They are in 4 lines of business. So there's a whole history here. If we have more time, I get into, but I'll give you the abbreviated story, which is 4 lines of business. The home hardware business, they're a large manufacturer of door locks in America. They're in the pet business for both, they make for both companion animals and in aquatics. They make rawhide chews for dogs, pet grooming products, etc. They're in the home and garden business. They make insecticides, pesticides, and herbicides. They're in the appliances and personal care business, where they make both shavers and personal grooming products, as well as kitchen appliances. So literally everything, right? And there's no rhyme or reason to what the business that they're actually in. Now, what's interesting is that 3 of these businesses, particularly the home hardware business, have public comparables that trade at very robust valuations, right? So too for the pet business and the home and garden, fewer comps, but these are double-digit EBITDA multiple businesses in the public markets. They're organically growing. They're competitively sort of well-structured and well-moated with attractive margins, and on their own would trade at healthy valuations. The 4th business here, which is the appliances and personal care, is a competitive, lower margin business that people who wish to own some or all the other businesses don't wish to own. And what you see happen in these structures frequently is you have several components that are deserving of high valuations. If one piece is unappealing to investors who might want to own some or all the other pieces would rather own a pure play focused enterprise and pay a full valuation for that rather than own exposure to a business they don't wish to own exposure to. So for example, in this case, someone wishes to own the home hardware business exposure via several, and they have several alternatives in the form of multi-billion-dollar companies like Allegiant, Assa Abloy, Fortune Brands, and Masco, don't necessarily want to own exposure to our appliances and personal care business. And therefore, the whole package, in these cases in general, in the case in particular, will trade at the multiple of its lowest valuation constituent part. So all these pieces together were trading at 7 times EBITDA when we got involved, despite 3 of the 4 businesses and the vast majority of the EBITDA being meritorious and deserving of a much higher multiple of EBITDA in its public trading. So we engaged the company. We bought a position. Sorry, David.
Keep on going.
We engaged the company and we said, look, we think you should divest your low multiple business. And you should reconsider your entire structure because this makes no sense together. These pieces all to be valued independently by public markets, by private buyers, but not in this current package or structure. We engaged. We actually confidentially nominated 2 directors to the board. I guess it's not confidential anymore, but it was a little while ago. And we said you need to reconsider this, or we will push for change because based on from a $50 share price at the 7 times EBITDA valuation we started at, we had a sum of the parts value of about $125. So material return embedded here, but again, nobody was focusing on it because people were looking elsewhere to express their views about owning these various other industries and markets.
So are you saying that this business that you were investing in, it had 4 disparate businesses as a mini conglomerate?
Yes,
And I mean, it looks like they were totally unrelated.
totally unrelated.
And so is the lack of confidence in the valuation, is that because people say, great, we're gonna give you, we don't know what your decisions will be on managing this business, so we're going to give you the lowest valuation as your multiplier?
It's a combination. It's that. It's the unfocused, the nature of the business. It's the history here, which I can get into more. But history had been one of, they actually used to own 6 businesses, and they got rid of 2. They had a leverage issue. So there's more complex history here, which again plays into the discounted valuation. And again, the idea that an investor would be happy to pay 15 times EBITDA for Accel-Go or for Allegiant, right, doesn't want to own exposure to an appliance and a personal care business. They'd rather pay much higher multiple for that exposure to a home hardware business than pay a full multiple and have to have some exposure to an unwanted business in the case of our appliance and personal care.
And the typical acquirer is like the leader in the industry or second in the industry?
So as it turned out, in this case, we put pressure on them to separate the appliances and care business, and there was a story a couple months later, as we were engaging with them, that business was for sale. Ended up not happening, but shortly thereafter, they announced the sale of their largest business, unexpectedly by us, but I think the pressure got them into the mode. They're selling now their home and hardware business, their largest business, to a competitor, to your point, to Accel-Go. Now you need the right competitor because you can't have too much market share overlap, or otherwise FTC gets involved.
I was going to ask that question.
But there,
then on the
European
client business, so I mean, one is heavy in one geography and another with another geography or whatever. Or
it's a European-focused business trying to get to the US. It's a perfectly synergistic combination, should be closing by the second quarter, and that highlighted the sum of the parts value. That series of events, first the consideration of the sale of the one business, and then announcing the sale of the second business, highlighted some of the parts value. When they announced the sale of the home hardware, they also announced they'd be separating the appliances and care business, which will be happening by the end of this year. So as this year finishes out, they'll be closing the sale of this large business and separating the home appliance personal care business, and left with 2 businesses now, from originally 6, then 4, then 2. The pet business and home and garden, that is a much more focused enterprise. You should get a much more appropriate valuation. We paid $50 for the stock a little less than 2 years ago. It's approximately $90 today. We still see upside, obviously, to our $125 case, and we still are shareholders here. This is a case where if we had not gotten involved, I am suspicious. I can't prove it. But I don't think the company would have taken these actions of their own volition. And candidly, because we have a catalyst requirement, if we had not been involved, it would have been uninvestable for us. There was no path of catalyst of actions that we could anticipate. Because we got involved and forced the action and forced the issue, we had a path to unlock value. It made it investable for us, and we've earned a great return thus far. And we think still more to go.
So is there an arbitrage? Do you find a distinction between Western European companies and American companies in terms of like their approach? Or, I mean, you said that you look at both,
Yeah,
right? So
it's definitely,
because I think that maybe some of the Western European companies tend to be more family owned.
Yeah, it's easier to engage with U.S. companies.
Okay.
The legal structures here, the governance structures here, the control ownership structures that exist in many European companies, it's easier to have it happen here. It's possible to engage actively, obviously, in Western Europe and the UK, where we also invest, but really we focus on the US primarily for our activist engagement. It's a different framework here.
Got it. Yep.
So that's one category of the kinds of catalysts and kind of names that we are invested in. The next we call new securities. These are things like spin-offs, post-de-SPAC equities are two examples. When a new security is formed, what we like about this is there are really 2 or 3 aspects of that we find very compelling. The first are the technical dynamics of how it's priced in the first place. These are securities that have no trading history. A spin-off is created by handing off shares to a shareholder of another company. There's no history, and these are people who did not choose to buy those shares. So you often have forced selling, or we call non-fundamental selling. That goes on. I'm handed a fraction of a share of a thing I didn't own buy in the first place. I sell without really assessing what is full and fair. Like, we like to buy from people like that. It's a classic dynamic that we find compelling. In de-SPAC situations, you're seeing now there's a huge imbalance in SPACs, which is not yet resolved, obviously, and from PIPE investors with SPAC shareholders, creating, again, forced action, forced selling, non-fundamental based assessments of value. We want to buy from people who are selling for, quote, the wrong reasons. That's a nice starting point for us in coming to a new situation. On top of which, and part of what complicates the issue for these people is a lack of the familiar tools in these new securities that they would use to value the situation. So things like historical financial disclosures. In spin-offs are very limited, in SPACs very, very limited. Things like sell-side coverage. You have no sell-side analysts, obviously, for a brand new spin before it comes to market. Things like historical quarterly reporting. You know, the familiar cadence of the reports, of the disclosures, in terms of the ebb and flow of a company's financial performance, such that you're relying upon limited information to form a view, if you're forming a view at all. because we've invested in spin-offs now, I've done it for 2 decades now, and de-SPACs we focused on the last several years, we know how to take what information is available and construct our mosaic all the same to determine our view of fair value for the new security. And again, we think the setup of how it's being priced in the first place, the initiation of pricing in the marketplace, is a favorable dynamic for us to consider. So we can do our work to determine fair value and it satisfies our return criteria. It's a nice way to start in terms of the investment life cycle for us. And from there, embedded in these situations is actually what we call a softer catalyst path, a softer path of events that will cause the value discount to be unlocked. These are things like sell-side initiations, things like management engagement with the buy side, things like index additions, things like quarterly reporting to give people that flow of information that they're used to when pricing a security. So if we do the work correctly to understand that there's a deeply discounted situation being priced in an inefficient manner, that will then have a natural path forward over the next couple of quarters or a couple of years to educate the market on what this company actually is, to better and more properly value it. That's a great situation for us. So we have an efficient starting point on pricing and a natural flow from that point of information to allow the market to properly value the security.
So just a couple of questions here. So you talked about de-SPACs and spin-offs. Do you guys look at reverse mergers like in the shells, like people would like take the company public using reverse mergers, or do you like look at Reg A offerings?
Yeah, so de-SPACs and SPACs are in some ways that, right? They're a version of a shell company in a sense. Yeah, it's and that's been an incredibly sloppy market. It's very upside down right now. And
it's crazy.
And look, many, if not most companies that went through the SPAC process that went public are companies we would never look at because they haven't done revenues for their 7 to 10 years and they're underwriting flying taxis and such. But there are actually some real companies, real businesses out there, a couple that we own in the portfolio, where you have really discounted valuations now on healthy, growing businesses that have gotten caught up in this technical morass. And we believe that coming out of this, when the supply-demand issue resolves itself and things stabilize in that market, they have enormous return potential, and they're being offered because of non-fundamental factors. So, and we also, in similar vein, broken IPOs. Again, broken de-SPACs are another version of that. You know how it is when the IPO breaks the offering price. You often see a significant wave of selling pick up in markets like these. That is a not uncommon event, and then it becomes people selling for non-fundamental reasons. Doesn't mean it's investable. Right? We have to go through our rigorous process, our full fundamental underwriting of the situation, but we like that starting point from the dynamic perspective.
So something that's kind of thematic in your presentation so far is the lack of coverage. Can you give some perspective on like Wall Street coverage these days? Because I mean, I don't think covering anything but the largest companies is a money-making business for Wall Street, right?
Yeah.
So I mean, how you and I were in Wall Street in the heyday back in the 90s and 2000s, where there's lots of coverage, and there's really been a pullback on that sort of activity. Can you talk about that a little bit?
Sure. One of the inefficiencies, and one of the reasons why we are focused on small and mid-cap, is the lack of coverage, is the lack of information, and we think a less efficient pricing mechanism than exists for larger companies. I mean, trying to find efficiency in large cap companies, even though they've been great investments, it's hard to argue for a lack of real market understanding of the asset, for a lack of efficient pricing mechanism, as you have dozens of firms, to your point, covering that and providing constant information flow to investors. Whereas again, in our portfolio, in that 1 to 10 billion sweet spot for us, you have companies, amazingly to me, with multi-billion-dollar market capitalizations that have 2, 1, or 0 analysts covering. And that's because, to your point, it's not as remunerative for the Wall Street firms to cover those companies. And for us, it's wonderful because the lack of information can create more inefficiency. And we do a deep, rigorous dive on every company we invest in. We know how to find information and learn about companies that don't have the traditional tools available. And that can be a differential opportunity for us and a competitive differentiator for us in assessing a view of a company's fair value. And just because there's lack of coverage does not mean it will be an interesting investment, does not mean it's inefficiently priced, but it helps. And I think that trend is only going to continue as more focus is on the larger, best fee-paying firms, and less attention is given to these small mid-cap companies. We can be invested there, and we can capture that excess return.
So just from a capacity of your strategy point of view, what is the difference? What are like? Is it what's like a 80%, 90% of public companies are mid to lower cap, or versus the higher market size?
Yeah, for us, capacity is vast relative to our strategy, in part because, again, small mid-cap is a big universe. We say 1 to 25 billion, the full menu. There are hundreds upon hundreds of companies we can consider constantly that fit into our value framework. And again, because we're concentrated, it's even fewer we have to find. right? So the funnel is big at the top in terms of things we could consider, and what actually comes out the bottom is very limited. Consider our strategy, our number of names, our time horizon. If we found 7 to 10 names in a year, it'd be a very robust year. So we have a limited need to find new ideas, and we have a lot of names to consider.
Because of your concentrated approach,
Yeah.
got it.
And each of these areas, the active engagement, the new securities, I'll cover discontinuous change in a minute, is a different funnel. Right, so on things like new securities, like spins and de-SPACs, there's a calendar. We engage with research services who give us a constant updated sort of view on what's coming down the pike, and there are dozens upon dozens every year of spinoffs and now of de-SPAC equities that we can consider. If we invest in a couple of those, it's a good yield for us.
Do you so it's primarily U.S. exchanges? Do you look at Western European exchanges? Do you look at Canada, Australia?
Yeah, definitely Canada, not Australia. North America and Western Europe.
Okay.
And as in North America is the vast majority of it. Canada, we do have a couple of positions in Canada. U.S. is the substantial majority of it, and Western Europe, when we find something interesting, we've invested there. I've invested my entire career. We're very comfortable investing there. We don't want emerging market exposure in the portfolio. We don't want that kind of risk in the portfolio. It adds a whole new vector to what can impact your returns. It's not where we have differentiated user expertise, and we don't want to introduce that volatility or different exposure to our return stream to our investors. There are other managers who are better at assessing that kind of risk and opportunity. So again, the third type. So we have certain new securities, we have active engagement, what we call discontinuous change. These are companies undergoing a structural change in their composition that we believe can create inefficiency and opportunity for us and ultimately returns for our investors. These are things like asset sales, large asset divestitures, or things like mergers and acquisitions, post-merger companies. In the case of an asset sale, a company can fundamentally change its capital structure, its cap allocation opportunities, and its business mix, which can support a higher valuation by divesting an asset. And the market sometimes is slow to update its view on that. It's a legacy view of a business. They sell an asset, which can change what it should be considered as. But the market often is slow to change its perspective on that company, and so to the sell side. And we can do the work to underwrite the impact of that discontinuous change, of that sort of shift in what was to what is. And if we determine there's a sufficiently interesting return to our view of fair value from the existing price, we then again enjoy a natural catalyst path, right? A path of catalysts that include the company having excess capital to reallocate to things like buybacks or return of capital or incremental M&A that is accretive to the business, and things like the sell side coming to better understand the new mix of business. There used to be a business where the mix supported a valuation of X. The mix today, post the divestiture, supports a valuation of Y. Hopefully it's higher if we find it on the long side, but we do the work to understand what is the new reality for this company, and is there enough return opportunity here for us to enjoy? If so, as the market comes to understand what we understood at the beginning, we'll be rewarded with returns on our capital. So a natural soft catalyst path, like with the spin-offs and the new securities, a soft path of the market understanding the new reality for the company, the aftermath of this continuous change event.
We have about 5 minutes left.
Okay, I'll talk even faster. The other is post-merger equities. Again, a company acquires another business. There can be revenue synergy, cost synergy, and again, a change in business mix supporting a new valuation. Market oftentimes does not fully appreciate the new earnings power of the company in the aftermath of the deal, may not appreciate the real synergy realization potential that can exist over multiple quarters or multiple years. Again, we do the work to understand what is the newly created company really about, what do they consist of, what is the earnings power, what is the appropriate multiple, and if it satisfies our return requirements, again, that education process, the sell side coming to understand it, the buy side coming to understand it better, and the company executing on realizing the opportunity, the synergy from that combination will be the unlocking events to cause a re-rating in the equity. Again, situations where you don't have a body of history for the company as it exists in the aftermath of the change. So it's a new company in a sense, and the market's learning about that company when we've already done the work to understand it, is the opportunity, is the natural path of events to allow us to realize a return on our capital. We'll talk for a minute quickly on risk management, obviously very topical in markets like these. There are a few aspects of our program. We are a long-only investor, but a few aspects of our investment program that have risk management embedded in our philosophy, in our DNA. The first is we don't lever. So we do not go beyond 100% gross long. We're officially allowed to go to 115 in our documents, but 100% gross long is our de facto limit. I've seen what leverage can do to portfolios in moments of market turmoil. Reference 2008, certainly, March 2020. And not quite there yet right now, but we're getting to a more tumultuous moment here. By being unlevered in those moments of market dislocation, you can be a rational actor as opposed to a forced seller. And gross exposure, in my estimation, we used to be a long short fund. defines risk more than net even, because things can go very, very, in very surprising directions in moments of dislocation in the markets. By being unlevered, you never have to be forced into an action. You can dispassionately and thoughtfully assess what to do with your capital, with existing names, with new opportunities, as opposed to having to react to amplified drawdowns because of leverage. So we think that's an important part of our strategy. We underwrite every investment to meet or exceed our target return for our investors. We don't need leverage to create the return streams for our investors. Additionally, I mentioned before, geographically, no emerging market exposure. So because we focus on mature established markets, again, they can be volatile in their own way, but not in the way that emerging markets can be. So we have a less risky profile to where we invest, and then to what we invest in. From an industry perspective, we are generalists in our program. We don't invest in two types of companies. One are what we call binary outcomes. These are things like biotech companies being the classic example, where it's a bit of a coin toss. Even if you have a view on the outcome of the coin toss, if you're wrong, it can be a full impairment of capital. We are not experts in this field, and we don't like the distribution of outcomes there, because we want to do work where we can actually have a competitive advantage in what we understand about the company, and not be betting on an outcome that we can't know with certainty or really predict. The other is commodities. Again, my experience is that if you invest in a commodity equity, you're investing in the commodity. It's a levered expression of the commodity, period. If it goes your way, great. If not, good luck. And we are not commodity experts. There are others who are, and we don't want to have the outcome of our investment, of our work, be reliant upon the commodity, which is a wholly different market, going a certain way. So we think it's a lower volatility and lower risk profile to the types of companies that we're investing in from a both geographic and from an industry perspective, which combined with our leverage profile, we believe creates a lower risk profile overall to our investment program. So I'll just conclude there. I'll just say that we believe that a concentrated strategy that focuses on fundamentally sound and deeply undervalued companies with a catalyst path to address the undervaluation, we think it provides strong return, differentiated returns, and with concentration and differentiated profile to our return stream in all market environments. And I think especially because it's topical in the current environment, we believe that having fewer names, having less exposure to broader indices, but specific deep views on a smaller set of names that have catalyst paths and strong arguments for being revalued is the right portfolio, especially in a market where the average stock in the broader index will be especially challenged.
So a quick question, you take separately managed accounts?
We do.
Great. And so you said your target was 20% returns. How have you done the last couple of years?
So the last couple of years have been good. We were up about 23% net to investors in 2021, about 28% net to investors in 2020, and about 26% net to investors in 2019.
And have you guys mapped out 2022 in terms of like targets and what you're looking at, or is there going to be much of a change in your portfolio, or what are your thoughts?
Yeah, it's been a wild year thus far, and in every respect. And I mean that in the good version of wild. Obviously, there are very serious things happening in the world right now. It's going to be a challenging year. It's going to be a challenging year for equities. I got a head start on that prediction because it's been one thus far. But look, you have beyond the geopolitical obviously developments of recent weeks, you've had this overhang of inflation and a Federal Reserve policy, which is very real. This is the first time in recent memory the Fed is actually committing to a tightening path, and they're not going to back down in almost any version of the world. I'm sure there's some tail event that can happen. They're unlikely to back down because inflation is real and has to be tamed. Right? So with that as backdrop, you have this issue. You're going to have some increase in 10-year rates versus where they were a year ago. The short end is going to come up as well. Again, these are things that I believe favor value equities over growth equities, but also favor, in my estimation, a more concentrated approach because the average stock should not have a great year in our estimation. The indices will be challenged, and the average stock, I think, will be challenged. We take comfort in having this portfolio that consists of fewer names. Again, we have half of our capital in our top 5 ideas. If we are successful in underwriting those 5 ideas, right, and close to 80% of it or 75% of it in our top 10 ideas, right? So if we underwrite those 5 or 10 ideas well, and there are actually events that take place that highlight the value or cause the market to reconsider value on those 10 equities, right, we should have certainly better results in the market, and really we think good results overall. So that's a strategy I'm much more comfortable with in this market environment than I would be having a more diversified portfolio. But I think in general for this year, we map it out, we expect a tough year. I think you're going to likely see a congressional handover in November. You're unlikely to see more fiscal stimulus come out of Congress over the course of the year. That's almost dead, if not entirely dead at this point. And so you have to really rely upon your companies, not the broader market lifting you up, but your companies doing things or having things happen to them to unlock value in your portfolio.